begin with planes, trains, and automobiles. The transport surging back today. Trucker J.B. Hunt crushing earnings. The airline soaring that group up 5% in just the past week. So, is the classic Dow theory, the idea that transports are going to lead the market, back in vogue? It's been around 100 or so years. Pete Najarian, does that move, the huge move for airlines, railroads, truckers, mean that there's an all clear?
I don't think it's that easy. I don't think the markets are ever that easy. Everybody loves to say that.
Is Dow theory dead?
Well, I would just say this. I would say that it's a great sign. And the airlines, we've watched them produce and produce and produce, and people still yet don't want to seem to own a lot of the various airlines. But when I looked at those Delta numbers last week, and it almost went by and nobody even talked about it, Brian, and yet they crushed it. They had a record second quarter. So we know right now that they do have pricing power. They've got great deals with the credit cards. When you look at United, you look across the entire landscape right now, I think the pricing power that they've got is impressive. And obviously with oil just kind of hanging around in this 50s, 60s, that sort of a range, I think that gives them a great opportunity to just keep printing money, which is exactly what the airlines are doing.
Yeah, but separate out the airlines from the rest of the transports, right? It's a very different story. So we have CSX earnings coming out after the close right now. It's worse than expected. J.B. Hunt's earnings last night were just slightly better than expected on weaker estimates. They weren't really that great. Now CSX comes out, says intermodal's down, said there's a slow drip down. It's not complete doom and gloom, but a slow drip down. That's the story of the interior of the economy. The airlines, I think, are very separate from the rest of what's going on in transport. So I would not look at a broad index and go, oh, everything's great in the market out there. These CSX numbers are not that great.
Yeah, but okay, I got to push back on you, BK. You got Canadian Pacific and Norfolk Southern. Those stocks are up 38%.
And they're down 4% after the close.
Yeah, but they're up 38% this year.
Yeah, but they're down 4% after the close.
They're up 38%.
Okay, great. But the reality is, the reality is that the earnings are not great that are coming out now. So whoever bought the last 38% was wrong.
Well, for 33%, they were right. But anyway, that's the same argument. But, no, I do think that to have this monolith of transports and have that be a proxy for the market doesn't make sense. I mean, the airlines, which I'm long some airlines, they seem to be great, although every time I hang on too long. I don't know if I should sell some into this.
Which airlines are you long?
Delta, American, United. But the transports to me is a bigger story, actually, the rail part of it. Right, as Brian's saying, CSX is coming out with, this is what I'm afraid of with the trade situation, that the uncertainty, they're looking, they said their second half is going to be down. And, we're seeing uncertainty. And so for a while, the market's been trading on this tide of macro events. Now we're getting into the nitty gritty, the earnings. That's what I like to see. And so to see rail earnings like this be this disappointing, that's.
But Jeff, it's funny because the two railroads that you think would be most smacked down by the trade fight, at least with Canada and Mexico, Canadian Pacific and Kansas City Southern, which has most of its revenue crossing the border, they're up 32 and 28% this year. Are you surprised by that strength?
Yeah, I am a little bit surprised, but look at the transports more broadly. It's been a nice move. I like to see them doing a little bit better, but as a broad index, they're still quite a bit below the highs previously. So to believe this move, I want to see a breakout past those all-time highs. If I'm being optimistic, I think that maybe this supports our view that we're going to see a cyclical bottoming in PMIs. I think you're still seeing tighter financial conditions flow through the economy. I think lower interest rates will start to support PMIs, so I think that's a good thing. But if you're looking for confirmation for the market overall, I still think there are things out there to look at. If you look at the breadth of the market, it's widening out.
Market cap, in a good way.
In a good way. Look at equal weighted indexes versus
but volumes,
market cap
Jeff, have been terrible. Yesterday was the slowest volume day since 2017.
A couple of days, it doesn't tell the whole story. You are seeing market cap weighted indexes and equal weighted index kind of perform together. That's a good thing. Look at credit spreads. The BBB credit spreads have hit a 52-week low. So thinking about liquidity, the credit markets, these are good things. And based on our work, we don't see sentiment as overly exuberant at this point. So I think you take the transport move with a little bit of grain of salt, look at some of these other areas of the market, and I think the setup is generally good looking out over the next, say, 6 to 12 months.
Anybody around the table believe that the overall market, the S&P 500, is overheated, is too high?
I bet you that guy
I mean,
does.
overheated's probably not the word I would use, but I'd be extremely cautious. I think the biggest risk that you have here is things stagnate. Not that we necessarily go into a recession, but because of the uncertainty that Karen was talking about, things stagnate. That's what you're seeing in these earnings here. And then at that point, you have to wonder, what does the market do? Have we priced in too much at this point in time? I would just be incredibly cautious. I don't think that, I mean, maybe we get a cyclical bottom, but what if we don't? What if things just stall? That's a problem.
Well, the one thing I think all of us here have been doing this a long time, that history has told us, is that markets can remain up or irrational, maybe, or overvalued, and I say that in air quotes, a lot longer than we think. There were people in 98 who were saying we're doomed. They were right, but they were 2 years too early, which means they were wrong.
Yes, yeah, absolutely. The one thing I'd add to we talked about volumes. You just did a second ago, Brian. When you look at the July volumes in the derivatives world, and the derivatives world is what I look at, not only because I came from that world on the options floors in Chicago, but when you look at when leverage was taken away after the financial crisis, where did that volume move? It moved into the world where I am, in the derivative side. We are seeing right now low volumes, to your point. I mean, we're 3 million a day under the average. We've only had 3 days
in derivatives.
In the derivatives. We've only had 3 days so far in July that have actually hit the average for the entire year, so at 19.3 million per day. So we are seeing low volumes, which is odd because here we are in earnings season, and you would expect to see those volumes really rushing back in.
So what does that
we're
tell
not
you?
Seeing those.
Other than there's maybe a lot of institutional interest.
It tells me that the participation right now is starting to back off a little bit. We've got volatility that's low, and Karen and I were talking about this earlier, but protection right now is cheap. And we talk about it all the time, and yet people don't like to hear it. But when you can buy at these levels, protection at 12.5 over a portfolio on the S&P 500, that's a great time to be a buyer. But when panic comes is when you've got that hurricane off in the side.
You got to make hay when the sun shines.
And
that's exactly, if I'm saying I'm cautious right now, I'm not necessarily saying you need to dump everything, but why not buy some puts with volatility at this level, right? Why not protect yourself? There are enough concerns out there that you should be at least protected. That's my point.
Well, you know, it's Karen, it's like we look at low volume as a negative sometimes, but, you know, if you like your car, you keep it, you hold on to it. And I wonder if low volumes are telling us that there's no buyers, but maybe there's no sellers either, that people are happy where they are and they're sticking with it.
Right. Well, so that to me reads a little of complacency, a little. I don't know. You could say complacent on either side as a buyer or a seller. But to me, I think Pete's point is so on target. The volatility is coming in here. I'm long. I'm always long, no matter what. No matter how scared I am or how bullish I am, I'm always long. That's what I do. So I'm not going to sell things into, a trade war that I'm afraid of, but I got to own protection. And if the VIX is going to stay here, I got to buy more protection. That hopefully I'll lose money on, the market will continue to go up.
But Brian, to your point about the market being able to stay expensive for longer than we think, I hate to make this argument because over the long term, it's not a good one. But look at the equity risk premium with what rates have done. It continues to blow out. It's the Tina argument. There is no alternative. It's going to be good in the short term for equities. It forces people out the risk curve. Again, over the long term, look out over the next decade, probably means lower returns for equities. But for now, I feel like people are being pushed into risk assets, and that's good for multiple.